Hello YouTube, welcome to my channel. My name is Jake and this video is part 2 on how to quickly analyze a company using the ratio analysis method. If you missed part 1, I highly recommend you to watch it because I show you how to analyze the income statement using the ratio analysis method. Before we go further on the balance sheet ratio equations, always remember that you should always be comparing the numbers with the industry average or other similar companies. In this video, I compare Alibaba, eBay's balance sheet with Amazon's balance sheet. So what is balance sheet? Balance sheet is basically a financial statement that summarizes a company's overall assets, liabilities, and equity. Assets are anything that generates cash. Liabilities are anything that takes away the cash due to buying assets, investing into R&D, or other activities to grow the future cash flow. And equity is all retained earnings plus cash that was contributed by the investors in exchange for the ownership of the company. It is very important for investors to understand how to read and analyze the balance sheet since it provides a snapshot of the current financial position of a company. If you can logically understand the financial position of a company, this can give you an insight on whether to invest or not, because since you're buying the ownership of the company, you definitely want to buy a company that is or can be profitable in the future and focuses on the long-term growth so that the stock will be worth a lot more later than when you bought it. This means that the investors should always be asking if the company have enough cash to expand. Does the company have more assets than liabilities? Does the company have more receivables coming in than payables? How liquid the company is? Can it cover the short-term debt? Is the company deploying shareholders' money on productive activities and so on? These types of questions can be answered in the balance sheet, and this is why investors must understand and know how to read and analyze the balance sheet. Profitability ratios. First, return on equity ratio is equal to net income divided by asset minus liabilities or equity. So ROE measures the performance of a company on how effectively the company utilizes shareholders' equity to generate profits. This ratio is very important because you as an investor obviously want to invest in a company that will use your money on productive activities to grow the company. Return on asset ratio is equal to net income divided by total assets. ROA shows how effectively the company uses its assets to generate profits. This ratio should always be compared to interest coverage ratios that I covered in part 1, because in most cases assets are purchased with using high leverage and the ROA could look attractive when the company might be struggling to pay its debt obligations. Cash to total asset ratio is equal to cash and cash equivalents divided by total assets. This ratio shows the percentage of the company's cash that is tied to the total asset to see if a company has enough cash on hand to pay off its debt or if the company has to rely on other forms of assets. Inventory to total assets ratio is equal to inventory divided by total assets. This ratio shows the percentage of a company's total assets that are tied up as inventory. This ratio could also show if the demand for the product that the company is producing is rising or falling, as well as how liquidity the company is. If the company needs to sell quickly in order to raise cash and assets are heavily tied to the inventory and the company cannot sell on time, obviously this can lead to big problem down the road, and too much inventory could bring in extra cost to maintain it. Liquidity ratios. Current ratio is equal to current assets divided by current liabilities. Current ratio shows how much short-term assets can cover the short-term debt. For any company, the current ratio must be above 1 or 100%, since it is obvious to have more cash coming in than going out. However, if the current ratio is too high, it could be a sign that the company is not managing its cash efficiently. Total debt ratio is equal to total liabilities divided by total assets. Total debt ratio shows the total debt percentage based on total assets. It is important for any company to have more assets than liabilities. Quick ratio or asset test ratio is equal to current assets minus inventory divided by current liabilities. Quick ratio shows the flexibility of the company on paying its short-term debt obligations based on its most liquid assets or short-term assets. Efficiency ratio. Inventory turnover ratio is equal to 365 days divided by cost of revenue divided by inventory. This ratio shows the number of days it takes for the company to sell all of its inventory. Inventory turnover is very critical in any business because you don't want unsold products to just stay in the warehouse and collect dust or low inventory turnover, because all of these could bring in extra costs in the future. Account receivable turnover ratio is equal to 365 days divided by revenue divided by account receivable. This shows how many days it will take for the company to receive its receivables. Obviously, shorter the better. Accounts payable turnover ratio is equal to 365 days divided by cost of revenue divided by accounts payable. This ratio shows how many days it takes to pay off its payables. It should be longer than receivable turnover because you want the money coming in before then going out. Working capital turnover ratio is equal to revenue divided by current asset minus current liabilities, or known as working capital. Working capital turnover ratio shows how many times working capital it takes to generate the current sales, and it measures how efficiently the company uses its working capital. This ratio cannot be used with the negative working capital because obviously it means that the company is not profitable. A decrease in sale indicates an increase in working capital ratio. Increase in sale indicates a decrease in the working capital ratio. Debt to equity ratio is equal to total liability divided by equity. Debt to equity ratio shows how much the company is financially leveraged based on equity. Most growth stocks will be highly leveraged, but as an investor, you should think about if the number that you're seeing makes sense and is it sustainable. Here are the comparison of Amazon, Alibaba, and eBay's balance sheet ratios. Amazon is showing 16%, Alibaba is 18%, and eBay is 40% on ROE. However, considering the market cap, currently Amazon is around 1.52 trillion, Alibaba is 679.1 billion, eBay 38.45 billion. Considering the overall market cap size, Amazon is generating a very impressive ROE. Return on asset ratio is 4% for Amazon, 1% for Alibaba, and 12% for eBay. As I mentioned earlier, a low ROA indicates that the company is not utilizing its short-term assets or total assets to generate profits. To increase ROA, the company must increase sales. Generally, 5% considered to be a good ratio on average, and Amazon is sitting around at 4%. Cash to current asset ratio for Amazon and Alibaba shows what I expected, but eBay shows only at around 8%. And investors should be cautious about investing in a company that has low cash in general, because having low cash could force the company to take in more debt than it can handle to pay off its expenses. Inventory to total asset ratio for Amazon and Alibaba is fairly low, and eBay did not report any inventory on its balance sheet. Since the ratio shows the portion of assets that are tied to inventory, having a low ratio is considered as good. Liquidity ratios. The current ratio for all three are showing above 1, meaning it has more assets to cover short-term debt. But Amazon is very close to being 1, meaning that Amazon is highly leveraged. total debt ratio for Amazon is what I expected since it focused heavily on growth, but Alibaba is showing overall debt is almost 3 times more than total assets. And this could be due to heavy expansion globally, just like Amazon, but that is almost at 3 times more than overall assets. This could be very dangerous, and the investor who's considering investing in Alibaba should definitely look in further. Quick ratio for Amazon is under 1, meaning that Amazon's ability on liquidity is very questionable. Efficiency ratio. Inventory turnover for Amazon takes about 39 days. However, Alibaba takes much less, and since eBay did not report inventory, this ratio cannot be calculated. Account receivable turnover ratio for all 3 companies shows earlier than their account payable ratios. Working capital turnover ratio clearly shows that Amazon is much better at utilizing its working capital to generate more profits than Alibaba and eBay. Lastly, debt to equity ratio generally it shows to be around 1 to 1.5 range, but companies like Amazon will use more debt financing to expand its business in other areas. Lastly, debt to equity ratio generally it should be around 1 to 1.5 range, but companies like Amazon will use more debt financing to expand its business in other areas. Amazon uses about $3.11 in debt for every dollar of equity. By comparing all the ratios with other similar companies as we saw earlier, Amazon is making good ROE and ROA, and Amazon also manages well on inventory, receivables, and payables. It also has enough cash to expand. One thing that's very clear is Amazon is heavily leveraged, meaning it uses lots of debt to grow its business. Generally, investing in a highly leveraged company could bring a big risk for investors, and the company may increase the likelihood of default or bankruptcy. However, I can tell that Amazon is very good at managing its debt because in the previous video, part 1, where I showed you how to analyze Amazon's income statement, and Amazon's revenue was growing at about 27% compounded annually. If Amazon is able to keep its revenue keep on growing at this pace, it's just a matter of time when Amazon decides to flip the switch and take in all the profits instead of putting it right back into their business. And this will impact greatly on the earnings and the stock price movements. Also, just based on the balance sheet ratios that we went over, eBay's ratios were very impressive. However, eBay's revenue was only growing at about 9% on average. In comparison, Amazon is currently at $1 trillion market cap and is growing much faster than eBay or Alibaba. In the next video, I'll show you how to analyze a cash flow statement using the ratio analysis method just like this one. I hope that this video was helpful in understanding how to read and analyze a balance sheet as well as to give you the motivation to jumpstart to analyze the balance sheet on your own or other financial statements because only you can control your investment and your financial freedom. If you like this type of video, please give it a like and subscribe so you won't miss part 3. And thank you for watching.